So a lot of people are looking at the crypto, the macro spaces at the moment and focusing on really an upcoming bull run, and holding on to hope that that's what plays out in the next few months. But I want to look at that narrative a bit deeper and share with you some reasons why I don't actually agree with that. And this video may inevitably come across a bit doom and gloom, but my aim is simply education, and to help really for people to see the bigger picture when you're investing yourself in crypto or the wider financial system, whatever it may be, just looking at the data that's out there and really understanding it. And before we get into this, I do need to say this isn't financial advice, it's just education, including my thoughts on the facts that are out there. And I'm going to be sharing with you graphs and facts and data, versus just rhetoric and my opinions. So let's jump straight into it. And the first metric I would like to share with you is interest rates. And this video is focusing on the US, by the way. The dollar is the reserve currency, as we know, and has such a large impact on global markets. So that's why we're focusing on the US and the dollar in this video. Obviously, I'm from the UK from my accent, but that's what we're going to be looking at. And if we look at the graph here, as you know, as you can see on the right-hand side of this graph, interest rates have been rising for some time. However, what you may not know or be aware of is if you look back in history, this always precedes a crash, a financial crash. So if you look at the red arrows that I've added here on this graph, these indicate the rising interest rates at every opportunity. And you'll see that every one of these red arrows, every time it increases, essentially, it's before an impending crash. And those crashes are indicated with the gray columns. So you can see the 2020 with COVID, you can see 2008 with the housing, you can go back to the 2000, go back to the 90s, et cetera, et cetera, et cetera. So what should be coming next if we look at that arrow on the right-hand side in 2022, 2023? Again, the red arrows always precede a gray column, which is a crash. The Fed lowers rates when things start breaking, essentially, and they can't do anything else. And that's what this graph tells us. They never actually lower them because they've been successful in what they want to do. They lower them because they have to, because of a financial crash. The second thing we're going to look at is the federal total debt. And as a percentage of GDP, which is essentially the gross domestic product, it's still well over 100%. And you can see it's 118.5% in Q1 of 2023. So what that means is debt is outweighing the growth, essentially, of the US, the GDP. So that's obviously not a good thing. So I'm just trying to dispel these myths in here. And you can see that on that graph, it's just increased pretty much since the 80s all the way up. Really, if the amount of debt the government has worried you and the increasing amount, let's look at the interest payments they have to make on that debt each quarter. So just look here at how that's kept rising and the huge increase in the past 2 years. Q1 of 2023, I've indicated here on this on the screen here, $928.929 billion. So nearly $1 trillion in Q1 of 2023, just on the interest payments on the debt. And remember, the debt is over 100% of GDP. Okay, so I really want you to be asking yourself, is this a healthy financial system? Are we going to lead into a bull run or a bull market with significant growth, which can last a period of time? We'll start on a positive one for GDP, because GDP is going up, as you can see in this graph. So that's great, or at least that's one good thing that we're going to be looking at here. However, we did shut down the entire financial system during COVID. We've never done that before in that way. So we are, at the moment, we're in unprecedented times. We don't know the implications of it, and we may not know the implications of that for some years to come. We can also look at the sharp GDP decline during the COVID. That's the gray column on the right-hand side. And again, in the first 2 quarters of 2022, we know there was a decline in GDP because there was a lot of speculation as to whether we were in a recession. And the outcome of that is that we weren't, and we've come back out of that with slight growth. But just remember, as we saw previously, there is more debt than there is GDP. Okay. All right, moving on. If you didn't know what M2 is or was, it's essentially the money supply. So put very, very broadly, it's a way of estimating how much cash or money is in the system. I'm not going to go into a lot of detail or explain this in a lot here, but just to give you an interest, I mean, there is an M1 as well. So if you want to look these up and get a real definition of them, you can do. But I want to give a broader picture here rather than going into too much detail. And what we can see here in the M2, the money supply graph, is that the money supply is still very high. Okay. So if you can see 2020, you can see the large increase in the money supply from COVID, where they obviously pumped a lot into the system. It's still very high when we compare it to where it came from before. So it has come down slightly. But if you think about the amount of interest rates have risen, it's not gone down by a lot, and it's still significantly above where it was previously. We do have to bear in mind that the Fed changed the definition of M2 in 2020. So if you see the grey column in COVID, what they did was effectively took out savings deposits, and that includes money market deposit accounts after May in 2020. So that big growth, big line going up that you can see, the big growth in the money supply, actually doesn't even include savings deposits, including money market deposit accounts. So actually that increase was probably much bigger, and we're probably in a much higher place in terms of the money supply currently. So question for you, is the financial system slowing down due to the increasing interest rates, the tightening, and liquidity being withdrawn from the market as we would expect? Is that the conclusion we're coming to? Are we in a healthy place? Are we in a position where we can get a new bull run or not? Let's look at the yield curve. The yield curve is seriously inverted at the moment. You can see that on the right-hand side of this graph where we are at the time of recording this video. It's below zero, all right? And that means it's inverted. Short-term bonds are still rising. The Fed isn't changing course, so the short-term bonds are still rising, and the 10-year bonds are not really doing anything, which isn't really a good sign of a healthy economy when we've got that situation, and that is what leads to the inversion of the yield curve. And if we look back in history again, a yield curve inversion has always preceded an economic crisis. So let's look at this graph that we've got going on here. You will see that it has gone below the line, below zero, before every crisis, even if you go back the last few. Okay, 1990, before it, goes below zero. 2000, before it, drops below zero, the yield curve inverts. 2008, before it drops. 2020, it got right on the line, and we know obviously COVID took place then. Look at how far below we are now, much more than 2008, much more than 2000. What's going to happen next is the question. Okay, I think most of us will be aware of the precarious situation banks have been in, with deposits leaving banks, going towards money market funds or being used elsewhere. And that obviously drains the liquidity of the bank. And we've seen the bank failures of Silicon Valley Bank, First Republic. So that's really shown us that they're vulnerable, they're under pressure, and there is an issue with liquidity here with banks. If we look at the performance of just some, Goldman Sachs, for example, is down about 8% in the last year. Bank of America down by over 13% and over 15% in the last 6 months. Okay, just to share a few bits of information. And again, these are random. This is not no judgment there. And actually, we should say that more money could leave the financial system, and this would drain bank reserves further, and it would lead to even more of a liquidity crisis for banks, and it may mean more banks going under, unfortunately, especially the smaller banks. And I just want to recap a little bit, take yourself back, because this might be a bit quick for some people. So please feel free to pause, go back, rewatch this video again, because it's a lot to kind of process if it's the first time you're looking at this kind of stuff. But remember, the Fed tightening is trying to remove, so the aim of the Fed is tightening the system and is trying to remove liquidity to bring down inflation. And it's doing that by raising interest rates, but by removing liquidity, you're putting pressure on the banks. So let's look at that in a bit more detail. We're getting a bit more complex here, but I'll try to just summarize. I'll try to keep it simple. We're going to look at two places here, one on this slide and one on the next slide in this video, that actually sit outside of the financial system. So any money that's placed here is not part of the financial system because it's held outside. For this purpose is what we're looking at. So when more treasury bills, and remember treasury bills, there's less risk where you're trying to hedge against inflation essentially. When these treasury bills are bought, this adds money to the treasury. And the treasury's general account is called the TGA account. Okay, so this is where that goes, where that money goes. And for this purpose, this is outside of the financial system. And this should ebb and flow, all right? What you can see here from this graph of the TGA account, this is the Treasury's general account, is if you look from April 2022 and go all the way to June 2023, you can generally see a decline in the TGA account. So what this means is because this is sitting outside of the financial system, a decline in this account means that money is essentially going from outside of the financial system back into the financial system. So from April 2022 to June 2023, more liquidity is going back into the financial system and being added back in. This should happen naturally, so it's not necessarily something to really be concerned about. The TGA account should rise up and down. There are other uses for it. It's not just treasury bills. It's their general account, so they have outgoings from this and other use cases. But we do need to be aware of if we're tightening, we don't want to see a large money back into the system. And the second system I want to look at that's outside of the financial system is reverse repo. So reverse repo is basically where some money market funds, some institutions can place money with the Federal Reserve and put it in their reverse repo facility. And what you can see here on the right-hand side is that, I mean, there's just under $2 trillion currently with the Fed in the reverse repo. So we've got a lot of liquidity outside the financial system that could come back in. We could say that the TGA is gone down and this money has gone back into the reverse repo. But actually, when you look at this reverse repo, it stayed fairly steady. It's dipped last few months, but actually it stayed quite steady. So actually we're not all that money's not come back into the reverse repo. And the recent drop in reverse repo account, as we can see, it's going down slightly here. This is moving back into the financial system as well. So liquidity is essentially moving from the reverse repo, which is outside the financial system, into treasury bills, again, outside the financial system. So what we're looking at as a general rule here is that liquidity is staying the same, really, give or take, maybe a bit more going back into the financial system. But the big tightening that we're kind of reading about is not necessarily happening. What we've got coming up is a lot of settlements as well. There's a lot of bill settlements, a lot of issuances coming up. So we'll see what happens here with this, but they can't just keep rolling this liquidity over year after year, surely. Maybe you have a different opinion. If you enjoy this video, if you're enjoying this content and you're getting something from it, please like and subscribe, and please let me know in the comments if you agree, if you disagree. But let's keep going. So if reverse repo, you see it's going down slightly. If that stops going down, i.e. money markets move from bills in the FGA account that we saw in the previous slide into the reverse repo, the money to pay for these bills will have to come from inside the financial system. So let me just go back to this TGA account. If money comes out of the TGA account because money markets want to put it in the reverse repo, then the reverse repo will go up. And that means the TGA account has less in it. So to pay for the bills, it can't come from the TGA account. So it has to come from inside the financial system, Remember, the TGA account and the reverse repo are outside the financial system. Therefore, you're going to have to pay from inside the financial system. Liquidity will be drained further, and bank reserves will be drained further as a result. And finally, when we're looking at banks, this is the last part on banks. I want to look at this and just introduce this to you if you haven't seen this before. So the Bank Term Funding Program was set up in March of 2023, and it was set up purely to help banks with liquidity. And it offers loans to banks from the Fed to banks of up to 1 year in duration. And if you look at the amount we're looking at here, loans of over $101 billion have been granted as of July the 5th, 2023. Okay, so it's being used, 100 billion of it, as loans. Okay. So again, I want you to really form your own opinion. I want you to think if I'm right, that a recession or something will be coming up, or do you think we are in a healthy situation? You can see consumer loans here. So we've got credit cards, other plans with commercial banks, and look at the increase, 2022, 2023. Is the financial system slowing down? Okay. We're about $750 billion all the way up to $1 trillion in about a year. Is that thing slowing down? I'm not going to go into the inflation base effect too much here, but essentially inflation has been going down recently in the US, which is great. It may go up again slightly in the next few months. So based on comparing inflation a year ago, and that is what a base effective is essentially, we might see inflation not continue to go down. And if you remember, the Fed's aim is 2%. So what will the Fed do if that 4% where it is currently plateaus or does increase slightly because we're comparing it to a year ago? We will see, but it may give them more incentive to raise rates further. And again, we know what that means. So where are we heading next? And the last metric I'd like to look at, and the last section of this video that I'd like to look at, is unemployment. So I've just talked about the aim of 2% really of inflation. But if we look at unemployment, unemployment is very low and it stayed the same. And I've included here on the top right hand side, July the 7th, payroll increases again, unemployment rate doesn't really move. So we would expect unemployment to increase. And if you go back to the gray bars, you'll see unemployment increasing in times of crisis, and we've not seen that yet. Okay, so that is what we would expect with increasing rates. So we may surmise there that we've got more rate hikes to come. We may have a recession coming up. We don't know. So if inflation does go down to that target of 2% that the Fed sets or has set, but unemployment stays where it is, very low, what we're going to find is that there's going to be huge wage inflation. All right. And what we can see from this graph is that unemployment is normally at its lowest when a recession starts. So if you look at the 2008 gray bar, the big chunk there in 2008, can you see just before it, that's where unemployment was at its lowest. And then you had it go back to 2000, unemployment was just at its lowest. And then afterwards you had a recession or an economic crisis. Go back to 1990, 1980, it's the same thing. All right, look at where we are. Unemployment is very low. What comes next? Unemployment usually peaks just after an economic crisis, then starts coming down when things change. The problem is that interest rates are going up at the moment, but unemployment isn't. So something has to give. Wage growth isn't slowing. I've just talked about wage growth, but we can see that in this graph here. It's not slowing. And in this video, we've not even mentioned things like commercial property with increasing working from home and all the office space and the impact that that has on the economy, or home prices where they dropped slightly. When you look at the S&P Case-Shiller Home Price Index in 2022, 2023. So we are in an unprecedented time, to conclude. this isn't financial advice. We can't predict the future, so we don't know what's going to happen. But in my opinion, I think we're looking at a recession or at least a correction relatively soon. And the important thing for us to do is just to educate ourselves, learn from what's happened in history, economically speaking, as I've tried to do with you today in this video. But there is hope. There's a bit doom and gloom in this video, but there is hope, because as in history, things go down, but there will be more bull markets and we will be able to benefit from them. But please let me know what you think in the comments below. Do you agree? Or do you think there are other factors at play here, or have I just got it drastically wrong? So thank you very much for watching. If you found this interesting, please do like, please do subscribe, and let me know if you would like similar content in the future or something different.